Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your friendly tax strategist who believes spreadsheets can occasionally be fun. Today we're exploring crowdfunding and how to turn community support into a tax-savvy funding strategy. Whether you're launching a gadget, recording an album, or raising money to expand a service business, understanding what's taxable, what's deductible, and how to plan the cash flow can mean keeping thousands in your pocket. I'll break down the 4 crowdfunding models, reporting rules, sales tax traps, entity choices, case studies, and a pre-launch checklist. Grab a coffee and let's make your next campaign profitable and audit ready. First, the landscape. Crowdfunding generally falls into 4 models: donations, rewards or pre-sales, equity, and debt, sometimes called peer-to-peer. Donations rely on generosity. Rewards or pre-sales exchange money for goods or perks. Equity sells ownership interests to investors. Debt raises money you must pay back with interest. The IRS views each bucket differently, which drives how you report income, deduct expenses, and plan cash and sales taxes. Picking the right model, or blending them carefully, can lower tax friction, improve marketing, and keep compliance manageable while you focus on building something your backers love. Now, what's taxable? Rewards and pre-sales are usually business income. If you collect $150,000 from backers for a new product, that's gross revenue, even if you ship later. Donations can be non-taxable gifts when used for personal needs, like medical bills with no strings attached. But donations raised to start or run a business are generally taxable income to that business. Equity crowdfunding proceeds aren't income. You're selling stock or membership interests. However, offering and issuance costs are typically capitalized, not deducted. Debt proceeds aren't income either. Interest and certain financing costs can be deductible. Reporting forms matter. Platforms or processors may issue Form 1099-K reporting gross payments. Thresholds have been evolving. Depending on the year, you may see a 1099-K at $20,000 and $200 transactions, at $5,000, or at $600. Don't rely on the form to decide what to report. Include all business income, period. Grants and prizes are often reported on Form 1099-MSK. Keep books that reconcile platform dashboards, processor statements, bank deposits, and your invoices. Record fees separately so you don't overstate income. When in doubt, create a reconciliation worksheet that ties every dollar to a source document. Sales tax is the sleeper issue. Rewards and pre-sales of tangible goods are often taxable based on where the item ships. Some digital items are taxable in certain states too. Marketplace facilitator laws don't always cover crowdfunding platforms, so don't assume they're collecting for you. If they aren't, you may need to register, collect, and remit in multiple states. Track where backers live and what you ship. Watch product taxability, shipping charges, and local rates. Build sales tax into your pricing and pledge tiers so you're not eating that cost later when margins are thinnest. Quick Missouri note. The state rate is 4.225%, and cities and counties often add significant local rates. Missouri's marketplace facilitator law is active, but many crowdfunding platforms aren't facilitators, meaning creators remain responsible. Missouri uses destination-based sourcing for shipped goods, so you calculate tax based on the buyer's address, including local districts. Economic nexus can be triggered if your sales into Missouri exceed $100,000 in a 12-month period. Keep an eye on shipping taxable treatment and exemptions. A Missouri address can carry several stacked local rates, so accurate software and address validation are essential. Timing matters. On the cash method, you're taxed when you receive funds, even if you deliver rewards next year. On accrual, many campaigns can defer income for advance payments under Section 451C and Rev. Proc. 2004-34, generally for 1 year to match delivery. If your campaign crosses year-end, plan which pledges will be recognized and when. Coordinate with sales tax periods and estimated tax dates. Align your fulfillment schedule with your accounting method so revenue and costs land in the same period as much as possible. That alignment prevents paper profit without cash. Deduct what you can. Platform and payment processing fees are ordinary expenses. Production, fulfillment, packaging, shipping, marketing, ads, professional services, and general liability or product liability insurance are typically deductible. Track cost of goods sold and inventory. If you're pre-revenue, some costs might be startup costs under Section 195 and entity organizational costs under Section 248. Generally, you can deduct up to $5,000 of each with phase-out after $50,000 and amortize the rest over 15 years once the business begins. Developing new technology, Section 174 requires amortizing research and experimental costs, usually over 5 years. Entity choice affects both income tax and self-employment tax. A sole proprietorship or single-member LLC is simple, but all net profit is subject to self-employment tax. An S corporation can reduce that by paying you reasonable compensation, subject to payroll taxes, with remaining profit potentially avoiding self-employment tax. Keep payroll reasonable and documented. Many creators qualify for the Section 199A Qualified Business Income Deduction, up to 20% of QBI, subject to taxable income limits and wage or asset tests. C corporations can attract investors but create double taxation. Choose deliberately before money hits the account. Price with taxes and fees in mind. Start with your fulfillment bill of materials, add packaging, shipping, platform and processing fees, expected sales tax you'll owe, and a margin for delays or breakage. Layer income tax on top using a conservative effective rate. If you're profitable, set aside cash for quarterly estimated taxes. Use safe harbors, generally 100% of prior year tax or 110% if last year's adjusted gross income exceeded $150,000 or 90% of current year tax. Park those funds in a separate account so production cash isn't raided when estimates come due. Case Study 1. A rewards campaign raises $150,000 for a hardware widget. You're on the cash method. The platform deposits $145,500 after $4,500 in fees. For income tax, gross income is $150,000. Fees are an expense. Cost of goods sold is $70 per unit for 1,500 units, or $105,000. Packaging and shipping add $18 per unit, $27,000. Marketing and professional costs total $6,000. Net profit before overhead is $7,500. Sales tax, 40% of shipments are in states where you must collect. Average rate 8% on the taxable portion. Build that into pledge levels or margins vanish. Case Study 2. Donations. If your community raises $60,000 for your spouse's medical treatment with no rewards and no business activity, those transfers are generally non-taxable gifts to the recipient. Document the purpose and keep platform records. Contrast that with raising $60,000 to buy bakery equipment. Even if labeled donations, the funds support a business and are typically taxable. The bakery can deduct equipment via bonus depreciation or Section 179 if eligible, but income timing and state conformity matter. Morale, the purpose drives taxation, so be explicit in campaign terms and your bookkeeping. Case Study 3. Equity crowdfunding. You raise $400,000 by issuing shares through a regulated portal. The $400,000 isn't income, it's capital. Legal, accounting, marketing, portal, and state filing fees tied to the offering are generally capitalized as stock issuance costs and don't produce a current deduction. Keep them off the profit and loss and track on the balance sheet. Post-raise, you'll owe investors periodic updates, cap table maintenance, and possibly 1099 DIVs if dividends are paid. Build governance, minute books, and a clean equity ledger from day one so future rounds, audits, or exits aren't derailed. Documentation is your shield. Spell out campaign terms. Donation with no benefits, reward with defined value, or investment. Track contributor names, addresses, pledge amounts, reward tiers, fair market values, and fulfillment dates. Keep separate business bank accounts. Maintain invoices, contracts, and W-9s from vendors. Issue 1099 NECs by January 31st where required. Common pitfalls: mixing personal and business funds, ignoring sales tax on rewards, underestimating shipping and packaging, relying solely on a 1099K without reconciling, and forgetting inventory. If the IRS asks, you want clean books that mirror platform reports and explain every variance. Before you launch, run this checklist. Choose the model with tax in mind. Map income recognition by method and delivery timing. Scope sales tax exposure by state, product taxability, and marketplace coverage. Price tiers to include taxes, fees, and fulfillment. Build an expense budget tied to tax projections. Select or confirm entity. Set up separate banking, bookkeeping, inventory, and sales tax automation. Gather W-9s and schedule estimated tax payments. Need a co-pilot? Premier Tax and Business Services can structure, price, and report your campaign so you keep more and sleep. That's a wrap on exploring the tax benefits of crowdfunding. We covered the 4 models: what's taxable versus capital or loan proceeds, 1099-K and 1099 MISC reporting, the sneaky sales tax piece, Missouri nuances, timing under cash and accrual deductible costs including startup and R&D, entity and QBI strategy, cash flow and estimate planning, 3 case studies, and audit-ready documentation. The takeaway: plan first, price smart, track everything. I'm David Robson. If you want a guide, reach out to Premier Tax and Business Services. Your community funds. We optimize the outcome.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.